Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're looking at two tech stocks to consider buying before Q3 earnings season and possibly holding for a very long time. And those two big tech stocks that are kind of the first wave of big tech names before, say, Alphabet and Amazon and all the really big names are Taiwan Semiconductor and NFLX. But before we get to everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into Taiwan Semi and NFLX, I quickly just want to go over where the market is and then take a look at the broader earnings picture as we head into Q3 earnings season. So the S&P 500 and the NASDAQ closed barely higher on Wednesday, and they were roughly flat as I record this roughly around midday on Thursday. So Wall Street's kind of sitting on its hands now as it waits for updates on what's next in the Middle East, as fears grow about a larger conflict between Israel and Iran. There's also now people waiting to see how quickly this dock workers strike impacts the U.S. economy. So with that in mind, the VIX, which is kind of that volatility index, is back up to about 19.7 as I look at this at the moment. So it's sort of at its highest. There's been four really high peaks over the last year. We're at kind of the third highest at the moment. We're way below its August 52-week highs of all the way up to about 28 in early September when it was above 22. So we're roughly around 19.7 at the moment. So elevated in terms of volatility. It is worth noting that October is historically weak during election years. There's the unknowns of what's going to happen in November. That said, though, historically, if you look back, no matter if it's Republican or Democrat in office, and Trump and Obama are actually a good test case that if you look at their terms averaged out, the S&P 500 returned almost the exact same amount during those stretches. So it proves that the big money in Wall Street is, no matter what you hear people saying, they're apolitical in the sense that they're trying to make money no matter what's going on. So that should just dissuade you of any fears of how the election goes, whatever your political beliefs are, that going forward, October could be volatile, and then there could be some volatility right after the election. But in the long run, Wall Street doesn't really care who's in office. They're in the money-making business. With that in mind, despite this recent spike in volatility, Wall Street's still kind of at the greed level at the moment. So CNN's Fear and Greed Index, which is often a pretty good contrarian indicator for the market. So this is like a stock market indicator. Good thing to take a look at if you've never heard of it before. Remains at greed level. So if it gets down to fear, that's kind of a good buy signal. And if it gets up to extreme fear, it's kind of a good time to maybe take some profits off the table. So that's where we are at the moment. Currently, the NASDAQ is trading above its 21-day moving average, though it's still solidly below its highs from the summer and trading at roughly neutral RSI levels. So that's a good solid place to be heading into the start of Q3 earnings season, which unofficially kicks off on Friday, October 11th with JP Morgan and some of the big investment banks. That said, before that, we're going to see results from Nike, which already reported, PepsiCo, Delta Airlines, Domino's Pizza, and others that are going to provide updates on the consumer spending side of the U.S. economy. And then before we look at the exact numbers, I just want to note that Shiraz Mian, who's the director of research here at Zacks, put out his big Wednesday earnings write-up, which is looking ahead to the Q3 earnings estimates. So that's kind of the numbers I'm basing this off of. So he noted that the recent declines in estimates for Q3 are a little bit steeper downward revisions heading into the start of Q3 earnings season than they had been in Q1 and Q2 of 2024, with 14 of the 16 Zacks sectors getting cut over this period. So since the start of the Q3 reporting cycle, with tech and finance the only sectors seeing positive revisions over that period, with this backdrop likely setting up pressure on big tech to hold up their end of the bullish bargain after the Fed cut rates earlier. So looking ahead, we're calling for roughly 3.7% total earnings growth for the S&P 500, and that's down from in early July, we were calling for 6.9% growth. So those estimates have gotten chopped down significantly. And so if we look at a whole, then we're calling for 3.7% earnings growth in Q4 and then 10% growth in Q4 And then if we look ahead to Q1 of 2025, we're calling for nearly 13% growth. So still, the longer term outlook is really impressive for overall earnings growth. And if we look to 2025, we're calling for 14.7% growth and then 13.1% growth in 2026, which would stack up really well against all the periods outside of periods over the last 4 years outside of the big 2021 rebound in that post-COVID comeback. So with this in mind, let's dive into two of the first major tech companies that are set to report their Q3 earnings results. And the first of those is Taiwan Semiconductor Manufacturing Company, which trades on the ticker TSM. The company is set to report its quarterly results, its Q3 results, on Thursday, October 17th. So in my mind, Taiwan Semiconductor, or TSMC, or just its ticker TSM, is one of the more straightforward, long-term buy and hold tech stocks out in the market. It is the semiconductor manufacturer with NVIDIA, Apple, and tons of other tech titans, all depending on Taiwan Semi to physically build the most advanced, complicated, and microscopic components that the entire global economy runs on. Its cost and institutional knowledge required to build these cutting-edge semiconductors create a really huge moat around Taiwan Semi. This backdrop is why Taiwan Semi stock has tripled the tech sector over the last 20 years. Its growth outlook is also really impressive, as all the major technological innovations, including artificial intelligence, are going to be fueled by chips that Taiwan Semi makes. It's also addressing some of those broader geopolitical fears by expanding its manufacturing footprint outside of Taiwan. On top of that, its valuation is solid, it pays a dividend, its balance sheet is robust, and we're going to look into more of the details of why you want to maybe consider Taiwan Semi before its earnings and then holding for a long time to come. So Taiwan Semi pioneered the dedicated semiconductor foundry business model that helped it evolve into one of the most dominant players in a vital industry. So it reportedly earned 61% of the semiconductor foundry market share in the fourth quarter of 2023, which was the most recent results I could find, blowing away second place Samsung with set at just 14. It's almost unrivaled, as I said, expanding its huge reach around the cutting edge of chip manufacturing. It's ramping up its industry-leading 3-nanometer technology. As I said, at the top two, its clients include Apple, NVIDIA, and really a ton of other giants of the tech world, all of which are coming to them to build their most advanced chips. Shipments of its 3-nanometer chips accounted for 15% of its total wafer revenue in the second quarter, while 5-nanometer accounted for 35% and 7-nanometer grabbed 17%. And TSMC qualifies all advanced technologies as 7-nanometer or smaller, so that made up roughly 70% of total wafer revenue last quarter. So they're at the cutting edge of the industry. And I mentioned also up top that it's expanding outside of Taiwan to diversify beyond the borders of Taiwan, which is now kind of one of the big geopolitical things overhanging the company that some on Wall Street are pretty nervous about. It opened up a plant earlier this year in Japan. It's also investing heavily to build factories in the U.S., fueled by government incentives. Those plants are taking longer to start construction than expected because of, as I said, just the institutional know-how, just how much goes into building these plants when you haven't built them in the United States for a very long time. So the company averaged 18% sales growth between 2018 and 2022, including 29% growth in 2022, before it suffered a cyclical downturn in 2023, which is not uncommon in the semiconductor space. But if we fast forward, it grew its Q2 2024 sales by 33% year over year and 10% sequentially. Its gross margin came in at 53.2% last quarter with an operating margin of 42.5%. It boosted its earnings and revenue outlook at the time when it reported in late July, saying with its CFO saying, quote, we expect our business to be supported by strong smartphone and AI-related demand for our leading-edge process technologies. The company is also projected to grow its sales, if we look at a whole, by 24% in 2024 and 2025 to go from about $69 billion last year to $106 billion in 2025. Taiwan's revenue growth is projected to help boost its adjusted earnings by 25% this year, so 2024, and then another 28% in fiscal 2025. Its overall earnings outlook have trended higher over the last year, with its 2025 estimate up about 13% during the last 12 months, and its 2026 outlook has also soared too. Taiwan Semi's upward earnings per share revisions help it earn a Zacks rank number 2 buy at the moment. And we should note that the company has consistently topped our bottom line estimates. Now we're going to move on to some performance, technical levels, and valuation. So Taiwan Semi has more than doubled the Zacks tech sector over the last 10 years, up over 825%, while more than tripling the tech sector over the past 2 decades. Taiwan Semi has also climbed 280% in the last 5 years, and it finally broke solidly above to new highs back in May. Its shares are up roughly 73% year to date, yet they're trading around 5% below their mid-July highs and 16% underneath their average Zacks price target. The stock was up about 2% as I record this on midday Thursday, having bounced off its 21-day moving average. It's also above its 21-week moving average, and it's not very overheated at all in terms of a 1-year and 10-year time frame in terms of RSI levels. The only way it looks a little overdone is when you scale that chart out to 20 years. So there could be some profit taking with Taiwan Semi and the broader tech sector in the coming weeks and months. And then any big downturn in any of these stocks you have high confidence in, it's just the opportunity to buy if you're a longer term investor. Taiwan Semi is trading at a 34% discount to its 10-year highs at just 22.4 times forward 12-month earnings, and 14% discount to the Zacks tech sector. And if for reference, a company, NVIDIA, is obviously they're not direct competitors anyway. NVIDIA is a client of Taiwan Semi, but it trades at 36.7 times forward earnings. And obviously its growth outlook is much larger, but just for reference, Taiwan Semi is trading at 22.4 times. So a big discount to this tech sector and its own highs. Taiwan Semi overall is one of the kind of pure play investments in the broader semiconductor industry. It's poised to grow for decades because it physically builds the bedrock of all technology, from data centers to AI. Its dividends yielding about 1.1% at the moment, and Wall Street's really high on the stock with 8 of the 10 brokerage recommendations coming in at strong buys. It also has no sells in there. And in full disclosure, I do own Taiwan Semiconductor in my own personal portfolio. And now we're going to move on to the other big tech names set to report on Thursday, October 17th, before the next week when the big wave of all the tech players start to roll in. That is Netflix, which trades on the ticker NFLX. Netflix helped change the entertainment industry forever. That's not arguable. The entertainment landscape looks a lot different because of what Netflix did, and they spurred everyone else to get into that business, changed the way people watch TV and movies. Its vanguard status and growing content library have helped it maintain its edge over Disney, Amazon, Apple, and all the other streamers who are in the business now. Still, its stock got crushed for slowing top-line expansion and fears about growing competition. Yet it's addressed most of those anxieties, crushing membership estimates in 2023 and the first 2 quarters of 2024. Its lower cost ad-based tier is gaining traction. It's also expanding into segments such as video games, cutting down on the amount of accounts people can share with each other. It's also getting into the live entertainment business, which is kind of the biggest new market for the streaming companies. So it announced a 10-year deal with WWE that will bring the popular wrestling show Raw to the Netflix platform. Netflix will also live stream more sporting events, so it's landed 2 NFL Christmas Day game or Christmas Day, the day of Christmas, the December 25th this year. So that's a kind of a big get for Netflix. It's going to be a games, which is the king of U.S. sports this season. The company's also rolling out more reality TV shows, which is kind of a huge growth frontier for the company. Simply put, though, more movies are going straight to streaming and giant stars are attached, and Netflix is in that business of at-home streaming entertainment as the world moves away from going to movie theaters all the time and moves away from linear TV in general. So if we look back to the fourth quarter of 2023, the company added over 13 million net new paid subscribers, which was 50% more than Wall Street projected. It was also its best quarter outside of Q1 of 2020 when the COVID outbreak first hit. So it's just showing the strength of the business that a lot of people thought. So many people went to Netflix during the pandemic that their growth would slow, but they just showed last quarter that their subscriber growth is big once again. Fast forward to last quarter, so Q2 of 2024, it added about 8 million net new subscribers, up 16% year over year to reach 277.7 million global memberships, paid memberships. So that's really solid growth. If we look at that, 16% growth was the best year-over-year growth of the last 4 periods, though the company added more in the fourth quarter of 2023. Ad tier memberships grew 34% quarter over quarter. So that's a really big new part of the business, is those people who pay a smaller amount with supported ads in that business model. The firm said that it's building its in-house ad tech platform that it will test in Canada and launch more broadly in 2025. So that's going to even boost the margins for that business going forward and streamline that ad business. Looking ahead, we're calling for roughly 14% subscriber growth in the third quarter to get up to 282.9 million global subscribers. That said, looking ahead to 2025, the company's not going to report these numbers at all. The company had previously stopped providing subscriber growth guidance, and they just then reported the number when they reported their quarterly results. But the company said earlier this year they're going to stop providing subscriber growth numbers altogether. This came as a pretty big shock to Wall Street at the time, since that had kind of been the metric that was most closely watched by Wall Street when the company reported. So if it beat big on the subscriber growth, the stock would drop, and then vice versa. The company said that the number of subscribers has become less meaningful with its current offerings with multiple plans and various price points. So they're going to focus on those more core metrics like margins and earnings and revenue growth. They did say they will slowly start to announce key subscriber milestones. So maybe when they hit 300 million or something like that. So looking ahead in terms of revenue growth, we're calling for about 14% revenue growth this year to get up to nearly 39 billion, and another 12% revenue growth next year to get over 43 billion, which is a significant percentage growth since last year they did about 7% growth, and the year before they did 7% growth. So it's good to see them getting back to that impressive double-digit growth, as the big reason for some of the stock price sell-off was that they're not going to be doing that 25% revenue growth that they were before the pandemic, or leading into the pandemic as well. And then on the bottom line, we're calling for a whopping 59% adjusted earnings growth in 2024, and then another 19% growth next year. And this would come on top of roughly 21% adjusted earnings growth in 2023. And overall, its earnings revisions have trended significantly higher over the last year for 2024 and 2025. Both estimates are up over 20% over the last 12 months. That said, some recent stagnation. The revisions have essentially remained exactly where they were in late July at the moment. So that helps it land a Zacks ranked number 3 hold. And if we move on to its stock price performance, it's up almost 1,000% in the last 10 years. This is blowing away tech, which is up just around 330%. And over the last 15 years, it's up almost 9,000%. So it's been on a staggering run. And the stock is up around 200% in the last 2 years. And it finally broke somewhat meaningfully above its 2021 peaks in September after getting rejected at that level in July and late August. That said, as I record this, the stock is down around 1%. It's trading at around $705 per share. Just for reference, its 2021 peaks were at around $690, so it's not significantly above that. So if you're looking, it could possibly, if it has a blowout quarter in the third quarter, it could finally break significantly above that level. That has been a little bit of a resistance recently, and this is speculative at the moment, but I wouldn't be shocked if Netflix joined the stock split camp at some point in the near future, because it's trading, as I said, at over $700 per share, which is a little prohibitive to a lot of retail investors. And then there's costs add up when it's that high of a share price for active traders as well. So there is some incentive to possibly split the stock going forward, which could then attract more investors in the near term. With that said, it's back above its 21-week moving average and trading above its 21-day moving average as well, sitting slightly above neutral RSI levels. And then if we look at its earnings or forward earnings, it's trading at 32.6 times forward earnings, which is a 90% discount to its highs, even though it's trading in terms of its stock price right near all-time highs, and 50% below its 10-year median. So it shows that its valuation has really improved even as the stock has bounced all the way back to its highs. For reference, tech is trading at around 25.8 times forward earnings. So yeah, it's much more of a value than it's ever been. And if we look now that the company is expected to stop reporting, or they're not going to report their subscriber growth every quarter, people are going to be looking at operating margin and that bottom line expansion. So in second quarter of 2024, their operating margin was 27.2%. And they're calling for about 28.1% in the third quarter of 2024, which would be up significantly from a year ago when they did 22.4%. So that's a thing to look for going forward, is can they improve their business? The company's balance sheet definitely needs improvement. It's not stellar for a big tech company that's gone on such a massive run. So its margin expansion in new revenue ventures and ability to consistently grow that bottom line should help going forward, as people start to look at the business as not this massive growth engine that it once was. But still, it's the king of streaming, which is the entertainment business to be in. And that's worth considering Netflix heading into its upcoming report and possibly breaking out far above to new all-time highs. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.